What is the yield curve? The yield curve is a graph that shows the relationship between interest rates or yields and the maturity dates of debt securities, for example US Treasuries. Whereas bills are those that are considered up to 1 year, notes are the ones that are up to 10 years, and bonds are up to 30 years. The x-axis represents the time to maturity, captured commonly up to 30 years, and the y-axis captures the yield, so the interest rate investors receive. In other words, it shows what investors demand to lend money to the government for short, medium or long-term periods. So, the yield curve visually tells you how borrowing costs change with time. What are the common shapes or types of yield curves, and what do they imply? Usually the spreads between 2 and 10 years time to maturity are taken into consideration when speaking of a normal or upward sloping yield curve. What it looks like, the long-term rates are higher than the short-term ones. What does it indicate in the economic realm? It indicates a healthy economy, expectations of growth and modest inflation. What if the shape of the yield curve is flat? So basically short and long-term rates are similar. It indicates a transition period, uncertainty about future growth or inflation. What about if the yield curve is inverted or the shape is downward sloping? Short-term rates are higher than long-term ones, and the economic indication is the following. It serves as a warning signal. Investors expect slower growth or recession. And what about a steep curve? Long-term rates are much higher than short-term ones. That indicates strong future growth and higher inflation expectations. What does the yield curve reveal to investors? The yield curve reflects the market's collective expectations for future interest rates, inflation, economic growth, and monetary policy. So basically, Federal Reserve actions. To be more specific, what happens when long-term yields rise? Investors expect stronger growth and possibly higher inflation. Hence, investors move into risk-on asset classes, whereas risk-off asset classes like treasury bonds decrease in value as yields and prices move inversely, as captured in the previous lecture. What happens if long-term yields fall? Investors expect slower growth or recession. They seek safety in long-term bonds. Accordingly, as yields and prices move inversely, prices rise and yields are depressed. What happens when the yield curve inverts? As we heard, when the short-term rates are higher than the long-term ones. Historically, this is one of the best predictors of economic downturns. The most common trigger for that is when inflation is running hot or is elevated, central banks increase interest rates on the short end of the curve, and as we heard, simultaneously, if expectations of slower growth are prevalent, that leads to depressed yields on the long end of the curve. How do investors of all kinds interpret the yield curve? Bond investors choose maturities based on expected rate moves, for example, buy long-term if expecting rates to fall. Stock investors use it as a macro signal. An inversion can warn of slowing profits and tighter credit, as well as what about economists or policymakers? They gauge market expectations about future growth and inflation to guide policy. Let's continue seamlessly and also narrow down in more detail how are short and long-term interest rates determined. Both are market-driven, but they depend on different forces. Short-term rates, so the ones up to 2 years, so treasury bills and 2-year treasury notes, are largely set by central banks. So basically the Federal Reserve's federal funds rate. Short-term rates reflect current monetary policy, inflation control and liquidity conditions. For example, when the Fed raises rates to fight inflation, short-term treasury yields rise almost immediately. What about medium and long-term rates, so the ones from 2 years onwards? They are determined by market expectations of future inflation growth and Fed policy. Hence, they are influenced by investor demand for long-term bonds. Let's also take into consideration the following factors. Global factors like foreign investment or a looming debt crisis in treasuries can also push long-term rates up or down. So in essence, the Fed controls the short end of the yield curve and the market controls the long end based on expectations of future conditions. To wrap up, the yield curve is a crucial economic indicator that reflects how investors view the future path of the economy, inflation and interest rates.